Let me tell you about the math nobody ran for you before you bought that rental property. You heard the pitch. Real estate is the ultimate passive income machine. Buy the right property, find a tenant, collect the checks. The 1% rule. The cap rate analysis. The landlord lifestyle. It sounds airtight on paper. And for a long time, for the right people in the right markets, it actually was. But the math in 2026 is different. Not catastrophically different for everyone, and I want to be precise about that. But for a specific type of investor, the kind of person who wants genuine passive cash flow without the operational grind of property management, the numbers are pointing somewhere else right now. They are pointing at dividend stocks. And the gap between the two strategies, when you do the honest math on both, is bigger than most people want to admit. I am Jenna. On this channel, we do not chase whatever is trending this week. We run the actual numbers, we compare them honestly, and we figure out what actually makes sense for your specific situation. Today we are doing exactly that with dividend investing versus physical rental property in 2026. Now, let us start with what happened to the 1% rule. For decades, the 1% rule was the quick gut check for rental property viability. The idea is simple. If a property generates monthly rent equal to about 1% of its purchase price, the property is worth evaluating further. A $200,000 home should generate around $2,000 a month in rent. A $300,000 home should be bringing in $3,000. That rule is broken in most major metropolitan areas in 2026. Completely broken. Here is why. During the pandemic, home prices appreciated sharply in most major markets. In many cities, values went up 30, 40, 50% or more from 2019 to 2022. Then mortgage rates climbed from the historic lows of 2021, where 30-year fixed rates were under 3% in some cases, to the 6.5% to 7% range we have been living with since 2023. So here is what that means in practice. A property in a major metro that would have penciled as a viable rental in 2020 now requires a substantially larger down payment, carries a significantly higher monthly mortgage, and competes with a rental market where tenants are already stretched. The rent that would make the 1% rule work in cities like Austin, Phoenix, or Miami does not match what renters in those markets can actually pay. Cap rates in major metropolitan markets in 2026 are running in the 3 to 5% range on average. Cap rate, for anyone not familiar, is the net operating income of a property divided by its purchase price. A 4% cap rate means that after operating expenses, your property generates a return of about 4 cents for every dollar of value. Before your mortgage payment. Before your personal income taxes. Just on the operational math. Now layer in the costs that have risen significantly since 2020. Property insurance has increased 30 to 60% in many Sunbelt and coastal markets. This is not a fringe problem. Texas, Florida, Louisiana, and parts of California have all seen insurers exit certain markets or dramatically reprice their exposure due to climate-related losses. If you own rental property in those areas and you underwrote your deal in 2020, your insurance line is almost certainly not what you projected. Property taxes follow a relentless upward curve. Markets that saw significant appreciation also saw assessments climb. Your equity grew, which is great, but your annual tax obligation grew with it. And maintenance costs. Trade labor has gotten more expensive. Plumbers, electricians, HVAC technicians. A water heater replacement that might have cost $1,200 in 2019 runs $1,500 to $2,500 today in most markets. A roof replacement on a modest investment property is $15,000 to $30,000. These are not extraordinary events. These are just the ordinary life cycle costs of a building that people live in. When you add all of this up honestly, many rental properties that looked like they would generate solid net cash flow are now running close to break-even, or in some cases slightly negative, especially if the property was purchased with financing in the last 3 or 4 years. Now, I want to be fair to real estate because I always want to give it its credit. The leverage advantage of rental property is real and powerful. A 25% down payment on a property allows you to participate in the full appreciation of the asset on an amount 4 times your actual investment. If you bought in the right market and held through the appreciation cycle, the equity you built is substantial. The depreciation deduction, the 1031 exchange, the ability to deduct operating expenses, these are genuine tax advantages that take real analysis to properly compare. But what I am specifically making the case for is passive cash flow, not total return, not equity accumulation. The regular, reliable, do not need to answer the phone income that most people imagine when they think about rental property. And on that specific metric, in 2026, high-quality dividend stocks make a very compelling argument. Let me explain what a dividend stock actually is, because I want to make sure we are talking about the same thing. A dividend stock is a share of a publicly traded company that distributes a portion of its earnings to shareholders on a regular schedule, typically quarterly. These distributions are called dividends. The dividend yield of a stock is the annual dividend payment divided by the stock price. So a stock priced at $100 that pays $4 annually has a 4% dividend yield. But the category of dividend investing that is most relevant to this conversation is what is called dividend growth investing. These are companies, usually large, established, profitable businesses that have long track records of not just paying dividends, but consistently increasing them year after year. The S&P 500 dividend aristocrats, for example, are companies that have increased their dividend every year for at least 25 consecutive years. These are not speculative small caps. These are companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola. Businesses with long histories of generating and sharing their profits with shareholders. Why does dividend growth matter? Because the power of dividend investing is not just the yield today. It is the compounding that happens when a growing dividend is reinvested into an appreciating stock. Here is the math I want you to sit with. Imagine two investors, each starting with $100,000. The first buys a rental property. The second builds a dividend growth portfolio. The rental property investor, using the 25% down payment for a $400,000 property, earns a net rental yield of 3 to 4% after operating expenses, and manages the ongoing responsibilities of the property. The dividend investor puts $100,000 into a diversified portfolio of dividend growth stocks with an average yield of 4% and a historical average dividend growth rate of 6 to 7% per year. They reinvest the dividends automatically. In year one, the dividend investor collects $4,000. Not exciting. In year 5, because the dividends have been growing and they have been reinvesting, the portfolio has expanded. By year 10, at 6% annual dividend growth plus reinvestment, the portfolio's income is not $4,000. It is more like $7,000 to $8,000. The income itself is compounding. Every dividend reinvested buys more shares. Every share buys more dividend. The cycle accelerates on itself with no action required. This is what financial people mean when they talk about the snowball effect of compounding. It is genuinely powerful. And it requires absolutely nothing from you after the initial investment. Now let us talk about taxes, because this is where the comparison gets genuinely interesting. The tax treatment of qualified dividends in 2026 is one of the most favorable in the tax code for most investors. Qualified dividends, which include dividends from most major U.S. companies and many international companies, are taxed at capital gains rates rather than ordinary income rates. For single filers with taxable income up to approximately $47,000, the qualified dividend tax rate is 0%. You owe nothing on those dividends. For most middle-income taxpayers, the rate is 15%. Only for very high earners does it climb to 20%. Now compare that to rental income. Rental income is taxed as ordinary income at your marginal rate, which can be 22%, 24%, or higher, depending on your total income. Yes, depreciation helps reduce that tax burden, which is a real advantage of real estate. And yes, the passive loss rules can allow you to write off losses against other passive income in certain situations. These are genuine advantages. But for the investor who is below the qualified dividend zero rate threshold, or even for the investor in the 15% qualified dividend bracket, the after-tax cash flow from dividends is often more favorable than the after-tax cash flow from rental income at equivalent pre-tax yields. And if you are holding dividend-paying stocks inside a tax-advantaged account, a Roth IRA, a Roth 401k, the dividends grow completely tax-free. Forever. That changes the math dramatically for long-term investors. Now I want to talk about something that the rental property pitch almost never includes in the calculation. The cost of your time. Property management is not passive. I have made this case before and I will make it again because it is consistently the most underestimated part of the rental property equation. When you own a rental property, your time is part of the operating cost even if you never write it down on a spreadsheet. Tenant screening, lease renewals, maintenance coordination, vendor management, local ordinance compliance, and yes, the 3 a.m. emergency calls. Some people genuinely enjoy this work. Some investors are skilled operators who build systems and manage properties well and generate excellent returns because of the skill and effort they apply. For those people, real estate makes a lot of sense. But if what you want is an income stream that pays you without asking anything of you in return, then the management requirement of physical real estate is a real cost. Dividend stocks ask nothing of you after the purchase. The quarterly deposit arrives in your account whether you are traveling, working, sleeping, or doing anything else you would rather be doing. There is also the liquidity difference, which I think is underappreciated. If you need to access capital from a stock portfolio, you can sell shares and have cash in your account within 2 to 3 business days. No real estate agent. No inspections. No closing costs. No 30 to 60-day escrow. You click sell and the money arrives. If you need to access capital from a rental property, you are looking at a minimum of a few months for a sale, real estate agent commissions of 5 to 6%, closing costs on top of that. And the possibility that the market conditions at the moment you need to sell are not the conditions you were hoping for. That liquidity difference is not just a convenience. It is a genuine risk management consideration. Emergencies happen. Opportunities arise. The ability to access your wealth quickly without a transaction tax of 8 to 10% matters. So here is how I want to bring this together. I am not telling you that rental property is always the wrong choice. I am not telling you never to own real estate. The leverage advantage of direct property ownership, the potential for forced appreciation, the tax benefits around depreciation and 1031 exchanges. These are real and they work for investors who are positioned and skilled to take advantage of them. What I am arguing is that the income comparison between dividend stocks and rental property, especially for the investor who wants genuine passive cash flow without ongoing management, is closer than the conventional wisdom suggests. And in 2026, with elevated property acquisition costs, rising operating expenses, compressed cap rates, and a favorable qualified dividend tax rate for most investors, the math tips toward dividends more clearly than it has in a long time. The practical question is not which asset class is universally better. The question is which one is better for your goals, your tax situation, your time budget, and your risk tolerance. If your goal is frictionless cash flow, tax-efficient income, total liquidity, and a portfolio that does not require you to be available at 3 a.m, dividend growth investing in a diversified, low-cost portfolio of quality companies deserves serious consideration alongside whatever else you are planning to buy. If you are already holding real estate that is working for you, the point is not to panic and sell everything. The point is to understand the actual comparison when you are allocating new capital going forward. Run your own honest math. Include every expense. Include your time. Include the tax treatment in your specific bracket. Include what liquidity is worth to you personally. And then make the decision that fits your actual life. Let me add one more layer to this, because I think it is the part that most convincingly closes the argument. I call it the hidden cost audit. Every piece of cash flow analysis I have ever seen on a rental property includes an estimate for maintenance. It is usually presented as a percentage of gross rent. 5%, 10%, sometimes 15%. The problem is that real maintenance does not arrive smoothly and predictably. It arrives in lumps. It arrives at inconvenient times. And sometimes it arrives in one catastrophic event that erases years of accumulated profit. Picture this. You have owned a rental duplex for 4 years. You have been running it reasonably well. The tenants are decent. The rent covers the mortgage, the taxes, the insurance. You are netting maybe $200 to $300 a month of positive cash flow after everything. Over 4 years, that is somewhere between $10,000 and $15,000 in your pocket. Then the HVAC system fails in July. The unit needs a full replacement. Depending on your market and the size of the unit, that is $8,000 to $12,000. One repair event. Half your 4 years of profit. Gone. Or the water heater fails and the resulting leak damages the floor in the lower unit. Repair and remediation. $4,000 to $6,000 depending on the extent of the damage and what your insurance covers, if it covers it at all. Or a tenant stops paying in month 9 of a 12-month lease. In many states, the eviction process takes 2 to 3 months minimum once notices have been served. During those 2 or 3 months, you are carrying the property without rent. Legal fees if you need to file in court. Any damage to the unit when they leave. That can easily erase an entire year of thin cash flow. None of those scenarios are unusual. They are part of the normal distribution of outcomes in rental property ownership. Every experienced landlord has at least one story from each category. Now compare that to a dividend growth portfolio experiencing a bad year. In 2022, the stock market had a rough year. The S&P 500 fell about 18%. Dividend-focused portfolios held up better than the broader market in many cases, but the paper value of a dividend portfolio still declined. Here is what did not decline. The dividends. Dividend aristocrats, the companies with 25-plus consecutive years of dividend increases, generally continued paying and increasing their dividends throughout 2022. The cash income the portfolio generated was not interrupted by the market's price decline. The income stream kept arriving. And investors who did not sell and simply reinvested those dividends at the lower prices ended up owning more shares at a discount, which accelerated their recovery when prices normalized. The stock portfolio had a bad year by the measure of paper value. The HVAC on the rental property cost $12,000 in actual cash. And the portfolio's market value has also grown significantly because the underlying companies have been growing. More importantly, not a single call was made. Not a single tenant was screened. Not a single maintenance request was fielded. The income arrived. Quarterly. Automatically. Into a brokerage account. With a tax rate of 0 to 15% on qualified dividends for most investors. That is the comparison the pitch does not show you when someone is trying to sell you on the rental property. Now I want to talk about accessibility, because this is a real advantage of dividend investing that does not get enough attention. To buy a rental property, you need a substantial down payment. In most major markets, buying a property worth $400,000 requires $80,000 to $100,000 in cash just to get in the door, plus reserves for carrying costs, plus reserves for maintenance. You are deploying a liquid chunk of capital into a single asset in a single location with a single tenant or two. To build a dividend growth portfolio, you can start with whatever you have. $100 a month into a brokerage account. $500 whenever you have it available. Fractional shares mean you can buy partial positions in companies that trade at higher prices. Commission-free trading means there is no penalty for adding small amounts regularly. The portfolio can be built gradually, diversified across dozens of companies and sectors, without the binary commitment of a real estate down payment. That democratization is real. The tools that existed only for wealthy investors 20 years ago, the ability to own a diversified income-generating portfolio with low costs and full liquidity, are now available to anyone with a brokerage account and some capital to deploy. So here is the blueprint I want to leave you with. Not a specific stock list, because that would be picking securities for your situation without knowing your situation, which I am not qualified to do and which you should not want me to do. But a framework for thinking about this allocation decision correctly. First, identify what you are actually trying to accomplish. If you want total return and are comfortable with leverage and management, rental real estate with genuine operator skill can still work well. If you want cash flow without operational involvement, dividend growth investing is worth putting on the table. Second, run your numbers honestly. For any rental property you are considering, include every cost. Insurance at its current rate, not the old rate. Maintenance as a realistic dollar amount based on the age and condition of the property, not a percentage that makes the spreadsheet work. Your time, valued at whatever your hourly rate actually is. Third, understand your tax situation. If you are in the 0% qualified dividend bracket or close to it, the tax efficiency of dividends is extraordinary. If you are in a higher bracket, understand what the depreciation benefit of real estate actually does for you after tax and compare it honestly to the dividend rate. Fourth, do not let social status drive capital allocation decisions. A brokerage account does not impress anyone at a dinner party. A rental property sounds more impressive. But what matters is the actual income it generates and the actual life it allows you to build. The cash flow that grows quietly in the background while you sleep, while you travel, while you build other things, that cash flow is the point. Whether it comes from a duplex or a dividend portfolio is secondary to whether it is actually reliable, growing, and not calling your phone at 3 in the morning. I am Jenna. Go run the honest math. And I will see you in the next one.